Welcome, everyone. Are you curious about the exciting world of the stock market or futures trading? Are you interested in learning about the financial markets to get started investing, diversifying your portfolio to boost your earnings potential? Either way, you've landed in the right place. My name is Yu. Why Yu? A professional trader with many years of experience under my belt. I've been navigating the tumultuous waves of the financial markets, particularly the futures, but also stocks, as well as options on stocks. In today's discussion, we will be taking a look at futures trading strategies versus stock options trading strategies. We will be doing a comparison for new investors or seasoned investors who would just like a refresher. We will do a deep dive on the comparison between investing or speculating with futures or investing or speculating via stock options. We'll take a look at some comparative advantages and how they might suit different investors based on their personalities, their risks and reward tolerances, etc.
Futures trading strategies versus stock options trading strategies. A comprehensive comparison for investors. The world of trading offers a plethora of strategies, each with its unique characteristics, risks, and benefits. Among the most popular are futures trading strategies and stock options trading strategies. While both can be lucrative, they cater to different investor needs, preferences, and risk tolerances. In this discussion, our aim is to provide a comprehensive comparison between these two trading approaches, helping upcoming traders and seasoned investors alike make more informed decisions based on their individual investment goals. As we delve deeper into this exploration of futures trading and stock options strategies, we're set to uncover the intricate layers that define their market dynamics. Imagine navigating a complex financial landscape where each decision can unlock new opportunities or present unforeseen challenges. This is the essence of what we will unravel together. Our journey will take us through the nuanced realms of risk and reward, where we'll dissect how these two strategies differ fundamentally not just in their mechanics, but in their very approach to market engagement. This exploration is more than a mere comparison of tools. It's an insightful voyage into the core of financial strategy making. As we delve into the world of futures trading, we'll uncover how this approach magnifies both gains and losses through leverage, a double-edged sword that demands respect and careful handling. We'll explore various futures strategies from the straightforward to the complex, including popular techniques like trend following, hedging, and spread trading, each revealing how futures traders capitalize on market movements and manage risks. Simultaneously, our exploration of stock options will reveal a universe rich with strategic possibilities. We'll examine a range of options strategies, from basic tactics like buying calls and puts to more sophisticated maneuvers such as iron condors and butterflies. These strategies showcase the flexibility of stock options, allowing traders to profit in up, down, or sideways markets. We will navigate through how options can be used not only for speculative gains, but also for income generation and risk management, adapting to an investor's market sentiment and risk appetite. By understanding the foundational elements of both futures and stock options, we aim to provide a balanced view that appreciates the strengths and acknowledges the limitations of each approach. We'll also delve into real-life applications of these strategies, illustrating how theoretical concepts are put into action in the dynamic world of trading. This comprehensive approach ensures that by the end of our discussion, you will have a deeper understanding of both futures trading and stock option strategies. Whether you are looking to diversify your portfolio, hedge against market volatility, or seek new avenues for investment growth, this journey promises to equip you with the knowledge and insights necessary to navigate the complexities of these two powerful trading domains. But our discussion goes beyond just understanding the technicalities. We aim to align these strategies with your personal investment narratives. Whether you're an aspiring trader looking to make your first foray into the markets or a seasoned investor seeking to refine your portfolio, the insights offered here are tailored to provide clarity and direction. Intrigue lies in the details, and as we progress, expect to encounter real-world scenarios, strategic comparisons, and expert insights that bring to life the applications of these strategies. This isn't just a comparison, it's a pathway to discovering your trading identity in the world of futures and options. So, stay with us as we embark on this enlightening journey. By the end of our discussion, you'll be equipped not only with knowledge, but with a perspective that could redefine your approach to trading and investing. Let's dive into the world of futures and stock options trading strategies and unravel the secrets to mastering these powerful financial instruments. Understanding the basics about futures trading and stock options trading. Before delving into the specifics, it's crucial to understand the fundamental differences between futures and stock options. Let's take some time to discuss the basics of futures trading. Futures trading involves contracts obligating the purchase or sale of assets at a predetermined future date and price. These contracts are standardized and traded on exchanges, covering a variety of assets such as commodities, currencies, and indexes. Mark-to-market is a critical accounting process used in futures trading, where the value of open futures contracts is adjusted to reflect their current market value at the end of each trading day. This adjustment is vital as it ensures that the gains and losses from futures positions are accurately reflected and realized daily. Each day, futures exchanges determine a settlement price for all futures contracts, and the accounts of all traders holding positions in these contracts are then adjusted to this settlement price. If the market moves in favor of a trader, the profits are added to their margin account, while losses are deducted if the market moves against them. This process ensures that all gains and losses are realized in real time, maintaining the integrity of the futures market. The mark-to-market mechanism has several important implications for futures traders. Unlike options, where the outcome is realized at expiration, futures trading involves a continuous cycle of gains and losses. This can lead to daily cash flow requirements if a position moves against a trader, as they may need to top up their margin account to meet maintenance margin requirements. The daily settlement process of mark-to-market makes risk management in futures trading dynamic, requiring traders to be vigilant about market movements and have a clear strategy for managing positions on a day-to-day basis. Due to the potential for daily margin calls, futures traders need to ensure they have sufficient liquidity to maintain their positions, contrasting with options trading where the premium paid upfront is the maximum loss for buyers. While futures can be used for long-term hedging, the mark-to-market process can impart a short-term focus to trading, as traders need to be prepared for the possibility of frequent adjustments to their margin accounts. Mark-to-market can amplify the impact of market volatility on traders' accounts, and significant market swings can lead to substantial margin calls, requiring traders to closely monitor their positions and market trends. In summary, understanding and managing the mark-to-market process is vital for success in futures trading. It differentiates futures from other derivative instruments like stock options by introducing a unique set of challenges and considerations. As a futures trader, mastering the intricacies of mark-to-market is as crucial as understanding leverage or the underlying asset itself. It's a core component that shapes the daily life of a futures trader, influencing everything from trade strategy to liquidity management. On the other hand, let's examine stock options trading. Let's take a little time to contrast the mark-to-market or daily settlement of the futures market versus the settlement used in the stock market. The settlement used for stocks and options on stocks is called T+2. The T+2 settlement cycle refers to the time frame within which securities transactions must be settled after a trade is executed. This term stands for trade date plus 2 business days. When you buy or sell stocks, the actual exchange of money and shares doesn't occur instantly. Instead, it follows this T+2 schedule. The trade date, often abbreviated as T, is the day when the trade is executed. This means it's the day when the buyer agrees to buy and the seller agrees to sell a security. The settlement date, which occurs 2 business days after the trade date, is when the actual settlement of the transaction takes place. This delay allows the parties involved time to arrange for the transfer of cash and securities. There are several critical reasons for the T+2 system. It helps manage risk by providing time to verify the details of the trade and ensure all parties have the necessary funds and securities. This process mitigates the risk of default by either party. The settlement period also allows for the processing of a large volume of transactions and the resolution of any discrepancies that might arise. T+2 is a standard adopted in global markets, helping to synchronize and streamline international transactions. The shift from older settlement cycles like T+3 to T+2 was made possible by advancements in technology and changes in regulatory practices. These changes were aimed at reducing risk and improving market efficiency. Unlike futures markets, where mark-to-market involves daily settling of gains and losses, stock market trades are settled in a lump sum after a couple of days. This difference reflects the distinct nature of these markets and their respective risk profiles. As we can hear from the previous discussion, the T+2 settlement cycle in the stock market is crucial for ensuring the smooth, efficient, and secure processing of securities transactions. It provides a standardized time frame for the settlement of trades, reducing risks and enhancing operational and regulatory compliance. Understanding T+2 is essential for stock market participants as it influences the timing of cash and security flows and impacts liquidity management. Understanding the differences between these two mechanisms is crucial for grasping how financial markets operate and manage risks. The key difference between the T+2 settlement cycle in stock trading and the mark-to-market process in futures trading lies in the timing and nature of the settlement of transactions. In the stock market, the T+2 settlement cycle dictates that the final transfer of stocks and the corresponding payment occurs 2 business days after the trade is executed. This cycle allows time for verifying trade details and arranging the necessary funds and securities. It is a post-trade process where the actual exchange of assets happens at the end of the settlement period, reflecting the trade's value at the time of the transaction. On the other hand, the mark-to-market process in futures trading is a daily reconciliation of account balances to reflect current market values. Every day, the value of open futures contracts is adjusted to the market's closing prices. This continuous adjustment ensures that gains and losses from futures positions are realized and recorded daily. If the market moves favorably, profits are added to the trader's margin account. Conversely, losses are deducted if the market moves unfavorably. This process not only ensures real-time reflection of gains and losses, but also necessitates that traders maintain adequate liquidity to meet daily margin requirements. While the T+2 settlement provides a brief buffer for stock traders to arrange their finances, mark-to-market in futures trading demands constant vigilance and immediate financial response to market movements. The T+2 settlement cycle is more about finalizing a transaction made at a specific past point in time. In contrast, mark-to-market is about continuously adjusting to the market's present conditions, making futures trading inherently more responsive to daily market fluctuations. These different approaches reflect the distinct nature and risks inherent in stock and futures trading. The T+2 settlement cycle caters to the structure of the stock market, where trades are based on ownership transfer. In contrast, the mark-to-market method suits the futures market, where contracts are based on speculations about future asset prices. Understanding these mechanisms is vital for market participants, as they directly impact trading strategies, risk management, and capital requirements. Stock options trading offers a distinctive approach within the financial markets. It allows traders the right to engage in the purchase or sale of a stock, depending on the type of option they hold. With call options, traders have the right to buy a stock at a price that is agreed upon beforehand. Similarly, put options grant traders the right to sell a stock at a predetermined price. These rights can be exercised within a specified time frame or on an exact date. This element of choice sets stock options apart from the more immediate nature of stock trading transactions and the daily adjustments to valuation that are characteristic of futures trading. When participating in options trading, traders are afforded a significant degree of flexibility. They can decide whether to exercise their options based on the current market conditions and aligned with their individual investment strategies. This flexibility is a stark contrast to the rigid settlement period seen in stock trading and the continuous mark-to-market process found in futures trading. The diverse uses of options include hedging against potential market risks, generating income by collecting premiums, and engaging in speculative activities based on predictions about market movements. An in-depth understanding of stock options and their strategic application is crucial in the realm of modern investing and trading. These options provide a tool of great versatility, fitting into a variety of investment strategies. They offer a level of control and a means of mitigating risk that is typically absent in straightforward stock trading or in the fast-paced and highly variable futures market. This diversification across strategies and financial instruments underlines the complexity and multifaceted nature of financial markets. It opens up a broad array of opportunities for investors and traders to manage risks and explore potential avenues for returns. Stock options trading offers the right, but not the obligation, to buy call option or sell put option a stock at an agreed upon price within a certain period or on a specific date. Options are used for hedging, income generation, or speculative purposes.